last two items.
Let's go ahead and call the November Budget and Finance Committee meeting to order for the city of Franklin. Ann is here, and I'll move that responsibility to my left.
Well, we have the consideration of the minutes from the October 5th meeting. Is there,
I'll approve a motion, or I'll make a motion to approve the minutes from
I will
October.
second those October 5th minutes.
any comments? All in favor say aye.
Aye.
Opposed, no. That passes. And our second is the election of a chairman and vice chairman for 2018. And I guess you're in charge of that.
Okay, yeah, I guess that's true.
I nominate Clyde Barnhill.
Okay, we have a nomination for our chair for 2018. Any other well, I need a second for that.
Second.
We have a nomination and a second. Any other nominations? Okay, hearing no other nominations, we'll close that out and we'll hand that off for a vote for the 2018 chair. The motion being that Clyde Barnhill be appointed to that position. All in favor?
Aye.
Aye.
Okay. Any opposed? All right, that's unanimously passed. And Clyde will be our chair effective January of 18.
Oh.
So,
Oh, okay.
yeah. So you can keep going. I can do it for vice chair too if you'd like.
No,
Do you want me to
yeah,
do
yeah,
that?
yeah.
Or do you?
No,
Yeah. I can go ahead and do that if you'd like.
Okay.
So let me ask for nominations for vice chair for 2018.
I would nominate Ann Peterson for vice chair.
Okay, we have
I'll
a
second that.
motion and a second from Alderman Speedy. Any other nominations? Hearing none, we'll close that out and we'll move to any discussion. Assume there's no discussion, we'll go to a vote for vice chair for 2018, Alderman Ann Peterson. All in favor?
Aye.
Any opposed? All right, so we've got that straightened out for 18, and I'll hand it back to the 2017 chair.
Okay. Okay. Yeah, yeah, that's right, that's right. Let us look at the proposed 2018 meeting schedule.
And just as a little bit of background on this administrative item, we are asking for consideration of what time that the committee wishes to meet in 2018, as well as I did attach to this item on the system the proposed dates for the 2018 meetings. We have made a couple of adjustments even in 2017, but we anticipated some of those adjustments here at the start of the year for you to go ahead and consider a calendar. And of course, if something occurs later in the year that we need to come back and ask for an adjustment, we certainly can do that, but we'd rather get these dates on folks' calendars if that's something that we can do early in the process.
So this includes our normal activity, which has been to not have a meeting in July because we've just come out of a pretty intensive meeting schedule with budget proposals and working through the budget itself. And then October, we had this conflict this year again with our finance folks and their statewide finance officers conference. So would like the help of moving that back a week so that all those folks can attend that conference and not have that conflict, and then do like we typically do, which is combine November and December meetings so that we can have the audit presented at that time as well. So that reflects our typical practice. The other thing, we didn't want to just assume the afternoon time works with a new alderman on the committee, et cetera. So we're open to whatever timing you want to do. The Thursday and the typical Thursday that aligns with the first BOMA meeting works pretty well from the staff side. So if we can stay around that time of the month, that would be good with us. But it's up to you in terms of what meeting time, et cetera, you all want. So that's up to what direction you want to provide us there.
Well, let's first ask, what about the dates? Is that okay?
That's the second Thursday. pretty
Second
much.
Thursday?
Yeah, it's pretty much second Thursday.
Uh-huh.
It aligns with the board meeting.
Okay,
Mhm.
so that,
I like the 2 o'clock time.
Like I said, the 2 o'clock works for me.
Is it gonna be
Okay.
okay because the rest
you
of
know
us
in
kind of
advance.
are on our own?
Like I said, as long as I have it in advance, I'm good to schedule around it, yes.
Okay, great.
And I like the two.
Okay,
Let's stick
so,
with that then.
And the one thing that's not on there would be the multiple meetings
That's
for the
right.
budget process
Yeah,
itself.
yeah.
Would you just, whenever you get closer into
And
that?
that's coming, right? We're gonna talk to you a little bit about schedule
We'll
later in the meeting.
We'll
so-
fill in the
Still.
February, March, and April meetings.
Yeah.
Those are
Those are
the
the
budget meetings.
Exactly,
Yes, yeah.
exactly.
And I
So
think for-
plan on
yeah.
multiple hours.
And those are, on these dates, they're just longer meetings for
Yep.
Yeah,
Alderman
for your
Speedy's.
scheduling purposes, I would count on
The afternoon.
3,
Block.
sometimes 4 hours to get
Yeah.
through all that we gotta get
So
through.
the
So
2 o'clock start, but we'll be not in until,
You're
hopefully
done
we're
by
done
dinner
by
time.
5,
Okay.
yeah,
at 6 at the latest.
yeah.
If everything goes well.
Right.
Well, do we need to make a motion, or is just that just agreed upon?
Sounds like we have our direction. I think
It's
we're good with that.
administrative.
Yeah, we can do that
Okay.
administratively, but wanted to make sure we got your preferences, so.
Then the item number 4 is consideration of a draft resolution 2017-71, a resolution to revise the organizational chart within the Franklin Police Department.
Thank you, Madam Chairman. Good afternoon. My name is Michael Walters Young. I'm your Budget and Strategic Innovation Manager. Joining with me is Will McCarville, the Fiscal Affairs Manager for the Franklin Police Department. Draft Resolution 2017-71 is a rather standard reorganization resolution. There is no financial impact attached to this resolution. What it simply does is clean up 2 things. Number one, there are a variety of minor reorganizations that reflect what the police department and how the police department is currently operating and organized that didn't quite make it in to the fiscal 18 budget. The most important one, though, is we are wanting to take 2 part-time administrative secretary positions, which are both vacant currently in the Criminal Investigations Division, and convert them into a full-time records clerk position. There is no financial impact with this. Both positions have been vacant. There's sufficient money in fiscal 18. With your positive recommendation, we can forward this to the board and then make sure that the org chart is updated for when you do see the police department budget in full in February.
And as your memo states, it's because, you're just having a harder time, police department, filling those part-time
Yes, ma'am.
positions.
My question, this is just being the new person, I guess the 2 part-times, we were probably not paying health insurance benefits for part-time employees, or?
Correct.
But does that maybe add some additional cost? We have a full-time person, now we are subsidizing health insurance and pension retirement plan?
It will. As a general budgeting philosophy for the city of Franklin, when we add a new position, we assume a 30% increase in addition for benefits. Healthcare, dental, vision, pension, et cetera. That's a good planning number, and you'll see that as we go forward. We've had these 2 part-time positions vacant, though, since the beginning of the fiscal year, if I'm not mistaken. So if you give the approval to fill this records clerk position, that's not going to come until 6 months in anyway. So we have sufficient funds to cover medical and pension for the remainder of fiscal 18, and then we can plan accordingly moving forward in fiscal 19.
Right.
We've seen this same problem. We've had to do this, I think, in streets and parks as well, where we're having a tough time filling
Yes.
part-times, and the labor market's so
Sure.
tight that the full-time is enough of a carrot that we do a little better filling them. It's still challenging, but we're doing a little better filling them, so that's kind of the judgment call. It absolutely works in this year's budget, and we'll need to fold it into next year's budget. It's a little bit higher cost, but not significant. in the
Right,
grand
and I
scheme
just
of
want to
things.
make, from my understanding,
It does cost us a little more.
incremental, but obviously,
Yeah.
it's,
Yep.
yeah.
And Chief and Will are confident to be able to absorb it in this year's budget and as we build next year's, whatever, $14 million budget, it's something we can work to absorb there. I do want to comment on one thing, just to make you aware of what we're doing. We have, and this is something we've done administratively, but has helped us, we have overfilled on a temporary basis one of the sergeant positions, because we have a deputy chief that is on military assignment, Deputy Chief Gentry, and he's likely to be on that assignment for another 12 months. So we have a vacant position. We need a little more assistance in the supervisory management side of the house. So we've had an additional sergeant filling that because we essentially have a vacancy in that senior deputy chief role. So budgetarily it works, but we've gone ahead and allowed that overfill for this temporary time frame as we move forward. So that's something we've been doing this year just to help cover the needs there, so.
Is there money involved here?
Yeah, there's, because while
Right,
he's,
exactly.
there's more than,
Yeah.
with a deputy chief position, it's essentially vacant. You know, we hold the position and
Sure.
all of those things, but we're not having to pay the salary because he's not working
Right,
for us at this
I see
point.
what you mean.
So it does allow for that budgetarily. It's actually probably a net benefit to us, but we do need a little extra help in the supervisory ranks to help offset that. So that's something I've been doing, really been doing all year because of the need. And we've had somebody step up and do that.
How long the deployment, or is up and down? We don't know.
It really varies. I
The
mean, we got,
deployment?
this initial deployment happened probably over a year ago, and then in the last month or so, we got additional word that it's gonna be another 11 to
So-
12 months. I mean, he's a brigadier general, so
Yes.
he's a
So it's
pretty,
not a set
He is a
thing. It's not
general.
he's a
set-
pretty
yeah.
high ranked, and so he's got some pretty significant responsibilities and
Yeah.
demands, so that's, it's a bit of a challenge for us, but this helps us manage it. So I just want to make sure you're aware that that's something I've done administratively to keep things moving.
So we're really back to,
I would
Have-
make the motion to approve the revision to the organizational chart within the police department and recommend that to the full board.
Second?
any other comments? All in favor say aye.
Aye.
Opposed, no. That then passes.
Thank you.
Thank you.
Thank you very much.
Thanks.
And it will go it's a recommendation from us.
Yeah.
The
Right.
board has to make the
Mhm.
decision. The full board, I should say. Okay, item number 5 is consideration of draft resolution 2017-85, a resolution to adopt budget goals for fiscal year 2018-19.
I will start, and I know Eric will probably want to finish. Resolution 2017-85, and a resolution to adopt budget goals for 2018-2019. It is customary to include a list of goals within the budget document for the city or for any organization. This is an important first step because it gives guidance and direction both to the city administrator and then to staff in the process that we're about to begin literally tomorrow when budget materials get distributed to departments on how to build and what they should be looking for in building their budgets and when they come in front of you to present their requests for the upcoming year. This year's goals are quite similar to previous years in a couple of respects. First, budget goals are divided into 3 categories. Number 1, financial. Number 2, non-financial. And number 3, specific to fiscal 19. A budget, of course, at its heart is a financial plan. It's also an operations guide, a communications device, and a policy document. But at its heart is a financial plan. It's important to include non-financial goals to provide proper context with all of the other various policy documents that you, the Board of Mayor and Aldermen, set forth, as well as departments use as their operation guides throughout the year. Envision Franklin, the Integrated Water Resource Plan, the upcoming Fire Strategic Plan, which you're going to get to hear a little bit about, we think, in a meeting or two, et cetera, et cetera. And then finally, there are specific goals for fiscal 19 that continue a lot of the specific goals we started in fiscal 18, efforts regarding capital planning and processing with Invest Franklin, and a lot of the other initiatives that you had asked us to target in the current fiscal year. Budget goals by themselves have no financial impact. Obviously, they do set the tone for the greatest financial impact that you vote on annually. In addition, we will continue to include and showcase your strategic plan, Franklin Forward. Each of the goals, whether they be financial, non-financial, or specific, are aligned with one of the 4 themes, and you have the icons next to each of those goals in attachment A.
So, yeah, Michael covered it very well. This is an opportunity for you and the rest of the board to give us any feedback on goals, either as they're written or additional goals that aren't here that you would like to see us encompass. So this sets the tone for what we try to implement in the budget as we bring forward. As Michael said, there's a lot of consistency in prior year goals because you've established policies and general direction that we want to continue to implement and strive towards. but there may be things you want us to emphasize in particular in the upcoming budget. And so we're open to that direction both tonight or over the next couple weeks as we bring this forward. Our intent would be possibly as early as the December 12th meeting to have the board vote on this, but we're open to that direction as well. But we do like it, the sooner the better, so that, you know, if there are specific things you want to see in there, that we make sure we're moving forward in our budget process to accommodate them. So glad to answer any questions you have or fill in or respond to anything about these specific goals.
I guess since I wasn't here last year, anything that's changed from the previous kind of
Not
3 main-
significantly. I've reworded a few things to reflect where we are, things like the compensation plan. Last year, the goal was about reviewing it and looking at strategies. We've given you a more specific plan that we are now in the process of implementing and will implement with the, finish implementing with this budget. One of the things we heard feedback on when we talked about that was the idea or option of we talked about some of the adjustments within pay grades for people for the time they've been in positions to avoid compression issues. And one of the things we were challenged with by the board is to look at an option that fully implemented that in fiscal year 19. So by July 1 of 18, we're going to look at how we can accommodate that. So I put a more general statement about implementing amendments to the compensation plan to ensure the city is a highly competitive employer. So that's a little different than what we saw last year. The board had asked us, and we are still carrying about $100,000 in this year's budget as sort of a pilot to help with some affordable housing initiatives. We've had a little discussion with Housing Commission members about looking at how that could maybe be used in a targeted down payment assistance program. There may be some other ideas out there as well. So I kept that in there in a general sense because I know that's a big policy issue the board is looking at and working on. We did carry some financial capacity in this year's budget. I feel like either from a policy or a fiscal side of it, you're going to want to have something there. I'm assuming you want to continue to at least have something in front of you to keep looking at that issue. But I kind of tweaked that a little bit to be a little more of just a general either policy or incentive approach to affordable and workforce housing in the city. So that one I tweaked a little bit just to try to make it kind of general, but something that supported both what's in this year's budget and what might carry over into next year's. Other than that, I did modify a little bit. It's on the last page, at the top of the page, where it talks about the capital investment program. Not a major change, but talked about continuing to move forward with implementation of approved projects in the capital investment program supported by Invest Franklin, but that we would look to be providing you an updated capital investment plan for the 10-year period from 2018 to 27. So we talked about sort of that second tier of projects that would fit in the 10-year window. I would see that coming to you first part of next year. And that would likely be something that we would want to have some budget implications in this year, the 2019 budget for sure. So that's really just making sure that that is something that's on our radar screen to do as part of our work plan. That's pretty much it. Everything else I think is fairly standard. There's one typo in that one that I want to fix.
So I was going to say, for
That's on
us-
me.
For us, we are very fortunate in that, you may know, we're one of the few AAA cities
Right.
in Tennessee. I think there are now 4, though. For a long time, there were 3. But I think I read something about Collierville has also joined Germantown.
There's 7 that
Oh,
have
7?
it.
Oh, okay.
But with 1, and I think there's 4 that have it, that are double AAA, if
Yeah.
you will, that have
Yeah.
2 rating agencies, and
Uh-huh.
we fit in that
Yeah,
category when
Yeah.
we generally go out.
yeah, because actually Brentwood and the county are also
Mhm.
AAA rated, which just means, we're very, we are,
blessed.
we are, that's right, we are.
Yes.
And
even
people
in
want
the-
to do business with us.
In the state of
Yes.
Tennessee, that's right. And I think really ours, though, our AAA is for the general obligation bonds. I think those water
Water and sewer
water
revenue
sewer
bonds.
bonds were
in the
that was
double
a
A category.
Double A category
Something,
for
yeah.
that. We did those separate for the first time this last year,
Uh-huh.
so that it stayed wholly within the water and sewer business, not supported by
Because
the
it has
general
to
fund.
support itself, period.
Which actually
It has
frees
to pay
up,
for itself.
we don't tie up capacity from the general fund to help with water and sewer. It keeps it so that we can use it for general capital projects, which
Yeah,
is
we're
a
kinda
healthy
getting
thing.
into,
It's a good
the-
thing.
The very next
Yeah,
item too.
that's right.
But, let's see, I guess there would just be a motion to recommend this to
Move
the
for
board?
approval.
Second.
Okay. Any other
The
comments?
debt-
We've already
no.
talked a lot. All in favor say aye.
Aye.
Opposed, no. Good. Well, and we were already talking a little bit
A
about,
little bit about,
oh, I'm
Do
sorry.
you all have
what
a
was it?
preference on that? Madison asked a good question there. Do you have a preference on whether this is put on the work session for discussion, put it on both agendas, or just put it right to the board meeting, the 7 o'clock voting meeting?
The board, you mentioned, you tweaked a couple of things, and if you can articulate that at the board meeting
Okay.
without the work, I mean, you
Okay.
can just sit at the board
And
meeting.
what
I'd
I'll
agree
probably
with
do
that.
is send it out to the board in an update,
Okay,
and so they have it in advance, and if they want to give any other feedback, we can do that, and I can highlight that for you. So I think we'll just put it on as new business at the 7 o'clock meeting on December 12th.
okay. Okay, so then, I guess we would include that.
What you did is fine, yeah.
Okay. Right, item number 6 is the consideration of Resolution 2017-81, a resolution for adoption of a debt management policy.
thank you. That was a good segue into talking about the
Indeed.
debt management policy. I just want to give a brief background, maybe for Alderman Speedy's benefit as well, that back I think by the end of fiscal year 2009, entities within Tennessee that wished to issue debt or who had debt outstanding were required to adopt a debt management policy, and the state gave guidelines. They did not tell local governments what they had to include, but they did give guidelines what needed to be addressed. And the city of Franklin adopted a policy in June of 2009, which incorporated those requirements as well as the philosophy of the board. It was meant to be a living document as tax law changes, as needs change of the local government. It may be amended, and it was amended in 2016. And as Eric alluded to, those were changes related to issuing revenue debt, solely supported by the revenues of the water and sewer system, as well as some other, I believe, some cleanup items, just as keeping it a living document. And one thing that we did look at, and this is the reason why I'm asking to have this considered for amending, was that with in calendar year 2017, in which it became more advantageous for the water and sewer utility to borrow through the state revolving loan fund. We have had state revolving loan fund loans for several years, and certainly they were allowable by our debt management policy, but it was not an explicit allowance. It was something that our attorney said was allowable, but it never actually said within this document state revolving loan fund. And to this point, our borrowing through the state revolving loan fund was fairly small amounts of money compared to the remainder of the debt was public offerings. And that was what was addressed by the policy. But as we have been approved as of September 22nd of this year to borrow up to $100 million for water and sewer projects, that becomes, of course, for staff, a significant borrowing.
So
And
you think that ought
yeah.
to be in there?
That's right.
I think
Probably makes
I'm
sense.
recommending that it actually puts that, is explicit on what state revolving loan fund and where that fits within our debt management policy. And we did work with our financial advisor, Public Financial Management, as well as our bond counsel, Bassberry and Sims, to make sure that was something that we did correctly state and put that language. And it's actually on page 4. This is it doesn't change the meaning of the policy, but it does help make this continue to keep this a living policy. On page 4, under types of debt, in the middle of the page, right below it is security structure, where it says general obligation indebtedness. That used to be general obligation bonds. We broadened that to be general obligation indebtedness. And you'll notice it's a pretty, about 4 lines of that particular subsection where actually state revolving loan fund is inserted. And that is an example, it's a living example for us of debt that is while it is primarily the first security, our net revenues of the water and sewer system, it does carry a secondary pledge of the general fund. And that is a requirement of the state revolving loan fund program. They certainly expect that in cases such as ours, in which the Board of Mayor and Aldermen also sets water and sewer rates, that water and sewer rates will be sufficient to pay the debt service. But there is a secondary pledge of the state supported revenues if for some reason the water and sewer revenues were not sufficient to pay debt service. So
Yeah,
And-
that
and
is
Chris-
different too, because really the state expects those to be raising the money that is necessary for those particular funds,
repayment of the debt, of that debt service,
Yes,
exactly.
yes.
I mean, and of course, they, as our regulatory agency, they will follow us on the water and sewer side to make sure that our financials are stable, and certainly we as staff recommend to you a program that will ensure that the state doesn't have to come in here
Exactly.
and do what they maybe have to do in some jurisdictions to make sure that water and sewer utilities are self-sufficient. But that is the change that we would like to propose at this time, and so that we can actually show state revolving loan fund debt as part of our debt portfolio.
I'm sorry, I don't have my iPad, so
yeah.
I can't, the things that I had marked on here in the circle, I
okay.
can't,
Oh.
I can't say what they were. But actually, you brought up one of them right there, and they were just kind of minor things in here anyway.
Christine did note, and I just would emphasize, the state revolving loan program does allow them, if they need be, to go to the state shared revenue. So that's kind of that additional coverage that they want. We've, of course, constructed our rate structure and our cost of service, all of that around supporting the debt needed to do especially the wastewater plant upgrade and expansion, which is that $100 million loan. That's what we're talking about there. And in fact, assumed a significantly higher interest rate. So we've got some additional capacity there that should help us even more so there. But that is there. That's part of their program. We've worked with them, though, to have a structure that really works well with the balance of the rest of our existing debt on the water and wastewater side. So we've really put ourselves and our ratepayers in the best possible position, we believe, by pursuing the state revolving loan fund. Our estimate, again, is that
That's
it
great.
saves us over $30 million.
right.
And that's a pretty
Right.
conservative estimate by going with that program over traditional or
Yeah.
typical revenue bond financing. So that's a good deal for us, but it's wise, given the magnitude of this, that we reference it in your debt policy.
And one other thing I remember now, one of the things I marked was that we generally have, we are right in that we will be allowed to call the bond if we want to, or refund, or if we get a better better rate. Of course, right now, I mean, the rates are so low. I mean, the market is, just totally gone
Well,
crazy even today.
And
But we're in a great time for borrowing money, I guess.
well, it's certainly, the reason we did want to bring this back is certainly that it is a living policy. There's, and as an example, just as I wrap up, certainly there's aspects within this policy that are contingent on what IRS, what are the federal laws regarding refinancings. And there's, for instance, there's references in this document to doing an advanced refunding of debt.
Yes, that's what I
And
meant.
there's right now the tax bill would eliminate advance refunding. So if that was for some reason approved the way it's been drafted and it's been submitted, we would probably, the next time we looked at this, we would certainly want to make sure that advance refundings were no longer part of our toolbox, because it wouldn't be allowed by federal law.
We
So-
have communicated that concern to our representatives, the mayors as well, to not only our representatives, but others from Tennessee that represent us and have important roles to play there. I don't know why you wouldn't want local governments to save
Yeah.
money where they could. So that's what we're going to continue to advocate for. and make sure that that's heard by our representatives in Washington, because that's an important piece.
It is.
Well, okay, then what about this synthetic, setup that we have?
Mhm.
Would that be affected by, possibly by the
Not,
proposed tax bill?
not, because the synthetic debt is actually considered variable rate, the underlying
That's
debt
right,
is
right,
variable rate debt.
Right, right.
The advanced refundings affect the advanced refinancing of fixed rate debt
Okay.
because it occurs more than 90 days before a call date. So
Mhm.
certainly, changes in tax law can require relooking at policies such as this, and we will certainly, we are monitoring those bills, and certainly when they, as circumstances change, we would bring back recommendations to keep this policy to be an updated toolbox for us.
But as I say,
Just
we're
hope
very
that we're not
fortunate.
too
Mhm.
surprised after
Yeah.
this bill is passed.
Yeah, we're,
Well, I'm assuming it's not really gonna affect Franklin as much, because we don't have a
No.
lot of high debt that we need to refinance. We're already,
We've done a lot of
Because
it
we've
in
done
recent
a lot of
years
it
when the rates
already.
have come down.
yes,
I don't know that there's
We,
a whole lot on our radar screen, but we keep an eye on it.
But while we do have, we actually make sure that our coupon, our structure on our debt, once it goes past 10 years, can be, we actually structure our new issuances so that it's attractive to refinance as we get closer to a call date. So we do make sure that our structure, our couponing structure is advantageous. We don't want to have some deep discount bonds to make it to where that would not be something that would be out of our toolbox, because typically when you shorten that duration after you pay off 7 or 8 years of principal and you're looking at just having maybe 10 or 12 years left, you can refinance at a lower rate just because you're not going out as far. So it will change strategies if
Okay.
we on fixed rate can't do an advanced refunding, and that would be reflected. Our strategy for fixed rate, having one advanced refundings in our policy now, it certainly it'd be, I'm already thinking and talking to colleagues about what some of those strategies would be if the tax law changes on us.
And Christine, like Russ before her, served on the GFOA debt committee. So that's from a national perspective, look at how debt is implemented and impacted. And that meeting's coming up in Washington,
We get
D.C.
together on
So
Sunday,
that's
so.
an important role, and we're glad that she and Russ before her have been active voices in that. That's important. So.
Thank you.
probably spend a lot of
Okay.
time on that,
So
but
you're gonna-
are ready to, I guess we move this to the,
Yeah, we
is
probably
there a
do.
motion?
Do you need a motion for the adoption of the management policy?
I think so. Yeah, I don't think we
So
have anything
moved.
yet.
Second,
Okay, any other comments? All in favor say aye.
Aye.
and will this go, I mean, we had a lot of discussion on this. I mean, is this going to the,
Well, typically, if you pass it
It's
Okay.
okay,
unanimously, we put it on consent.
okay,
But
Yeah,
if you all, if it's your
absolutely.
guidance that
No,
you think the
Absolutely.
whole board could benefit from a discussion, we take that guidance too. So
we don't have any.
there's not a lot of
any knowledge
major
now.
changes
It's just
here.
that
So.
we've just
Yeah.
been talking about anticipation of
That's right.
possibilities,
Right.
and that
The
just.
only significant change now is just adding in
Yeah.
the state revolving loan fund.
Right,
Yeah.
right, and it's kind of getting in the weeds, you know,
Clarification of
other
that.
people. I
Mhm.
think you're right, I think
Yeah.
just the
Do the normal.
normal, yeah. Okay. The item number 7 is consideration of a draft extension to contract number 2011-0118, contract between the U.S. Bank and the City of Franklin for a custodian relationship relative to the City of Franklin pension plan.
This item regards the closed City of Franklin pension plan, in which employees that were full-time employees that were hired before January 1st of 2017 are members of this closed plan. Back in 2016, that the board entered into an agreement with the Tennessee Consolidated Retirement System for a management of investment management services, and then we began working with TCRS for transfer of administrative functions of the closed plan. One of the aspects, there's a couple of aspects. One is the custodian bank, U.S. Bank, which was procured back in 2011. They have actually also been serving in an important role of paying the monthly benefits to retirees, as well as preparing their monthly reporting to the IRS and some annual reporting as well. TCRS has given us indication that they'll be able to do that service for us as part of consolidation of services with them. But they are fairly new at pulling together these services for closed plans. They had first given us an indication they would be ready to start at the very beginning of 2018, and now they're giving us a target date of April of 2018. We are in consultation with them, but we are a little bit at their discretion because they're the ones taking over this important service to us. It's not really feasible to rebid because we know within a fairly short amount of time that we're going to be going to TCRS. We also do not want to go. We also would have to contact all of our retirees and sign up, get them signed up if we changed banks, because we're getting ready to be doing that with our retirees once we go to TCRS. And it's a staff recommendation that we stay with U.S. Bank. We would hope that it will be April 1st, but certainly we expect in 2018 to be able to move those services over to TCRS. We are working with law department exactly to how to, and that's why we're still in draft form on how this would work. But U.S. Bank has given us a slight fee increase to keep us, and we are having very good service relationship with them right now. So we feel confident that they can provide good service until we do go to TCRS. We do anticipate a monthly increase of about $225, given the current number of monthly payments that we make in the retirement program, as well as an annual fee increase of $2,500. So we are asking for your consideration for have us stay with U.S. Bank and continue working with the law department to exactly figure out what that document would look like. But Sean is confident that she's working to make sure exactly how we will legally do that. But certainly for the benefit, for the ease of this transition to TCRS, staying with U.S. Bank a little while longer is preferable.
And Sean is just looking at the best mechanism to do it. I think we're very comfortable that this makes sense to do. And we even hunted around over the last year at some other third parties that might do this service for us, and this is by far a better value compared to if we went to some other third party that does these kind of checks or this kind of service. So this is a modest cost increase over what it is now, but in the grand scheme of things, it's very manageable and probably the best value we could get to do this. And as Christine said, it's a very limited period of time we're looking at.
Move for approval.
I'll second that and would say that I see no reason to change something
No.
for 3 or 4 months
Exactly.
and have somebody
Change it
sign up
again.
and then come back 3 months later and have the retiree sign up again.
Yeah.
Plus, as best I remember, they've done a good job of the checks and all the stuff that we've asked them to do. So I'll make, I've already seconded your motion.
The motion's been made and seconded.
Sure.
Any
And
comments?
administratively, you said probably May or June, they're gonna roll on to TCRS anyways,
Yeah,
right?
so-
My only question is, like, are they gonna prorate the minimum annual fee, or are we on the hook for the whole 7,500 for 4 months? That'd be my only question.
We probably will keep the custodial bank. In addition to these services with making monthly payments, we've got a little bit more time on the custodial bank side because we have a few assets that
Okay.
we're still having to sell, and they are still the custodian. Now, once we have the monthly remittances moved to TCRS, we can look to changing a custodial. We could go out for a custodial bank because we do have a little bit more time on some of these assets, but we really need to get through this transition on the
Sure.
administrative services, and then we can kind of decouple. So we may actually have U.S. Bank provide some custodial banking services, maybe even
Beyond
closer
that,
to the calendar year. But we'll update you, and we'll keep you updated as far as the timing with TCRS, because that's going to tell us when we can start looking at the remaining services that U.S. Bank provided under the custodial bank agreement.
I would say one other thing, Russ happened to, I think, put this in the mailbox. The value of the account is now at a little over $102 million. So, the account has done well the past year
Yeah,
and has done well the
Yesterday.
past many years.
But it is a change that will be a good change eventually, and but this sounds like it's the way to work. Now, and we have our motion
Yeah,
and
that's
second. Any other comments? Okay, all in favor, say
Aye.
aye. Opposed, no. It passes.
And on that globally, we have seen a reduction in administrative costs overall.
Oh.
I mean, that is one of the things we had hoped to see with the TCRS change, and we have seen that already and expect to see that more going forward. So it's been good. While this goes up slightly, grand scheme of things, we're paying less to administer the program than we were
That's
when it was
interesting.
solely the city operating it.
That's
Continue on with that, because that is money manager fees that we were paying for the many
Oh,
many
that's
different
right.
accounts that
And
we
that's
had.
one of the
So
reasons
we
this is
now-
gonna be a
Got
We
more.
better.
now
Good.
no
Yeah,
longer
go
have
ahead.
those.
We had reported to the pension committee around $400,000 of saved
Wow.
fees,
Mhm.
because TCRS's investment group is primarily, they're managing over 90 million
Yes.
of that $100 million. So what we're running out is a small percentage of the portfolio.
Very good.
So, okay, yeah, it sounds good in many respects then. Item number 8 is acknowledge receipt of the comprehensive annual financial report for the city of Franklin.
While our auditors are joining us, I just want to make a couple of just very brief comments. In going through my first audit process here at the city of Franklin, it's been an honor, and I've been you don't hear people talk about enjoying going through audit processes.
Are you okay?
I'm going to say it has been an honor to work with my colleagues, and several of my colleagues that I'm fortunate to work with every day are here in this room, and I'm going to quickly introduce, but they do the hard lifting, working with departments. I'm fortunate to work with Mike Lowe in our accounting staff. We have Lori Pope, and we have Glenda Driver here on this one side. Have Katie Hilty, Ashley Perry, and Angelique Franzoni. And they're the ones who do the hard lifting in this process. I'm fortunate to work with them, and I know our auditors they compliment me on the folks that they work with every day. So thank you for indulging me, but I do want you to recognize who really does a great job, and I'm very fortunate to have worked with them this year on our audit. And we have with us from Crossland, we have Dan Miller and Jennifer Manderdock? Monternock. I got close, I'm very sorry. So we welcome them and look forward to their report.
Well, thank you. Good afternoon. It's a pleasure to be here with all of you again to go over the results of the city's financial audit and also the conference center. And Jennifer is going to start with the audit results on the city, and then I'll go through briefly some high points in the CAFR, and then we'll also talk about the conference center. So everybody should have a book with all 4 documents together.
Okay, I'm going to start with the results of the audit. The first part is our cover letter. We would like to thank you for the opportunity to serve as your independent auditors and business advisors for the city. We are pleased to provide our report on the results of the audit as of June 30, 2017. A direct line of communication between us as your auditors and this committee is essential to the proper exercise of our respective responsibilities. We have some required communications in here that I'm going to go over. We have completed our audit of the financial statements for the city and drafted our unmodified opinion. The state of Tennessee has oversight responsibility and has approved our audit engagement through the CARS website. The city will be meeting their reporting deadlines for the federal and state governments, as well as the GFOA Certificate of Achievement program. To be your auditor, we are required to be independent. We reevaluate this independence annually, and I can confirm to you that we are independent with respect to the city. On the bottom of page 2, we've listed the engagement personnel that worked on the audit this year. The personnel are consistent with the prior year. We have a responsibility to perform our audit under U.S. generally accepted auditing standards. Our responsibility is to plan and perform our audit to obtain reasonable but not absolute assurance on whether the financial statements are free of material misstatement. We also perform the audit under the uniform guidance, which is the compliance piece. We examine on a test basis evidence about the city's compliance with the types of compliance requirements described in the OMB compliance supplement that could have a direct and material effect on its major federal programs for the purpose of expressing an opinion on the city's compliance with those requirements. The financial statements contain certain accounting estimates, which are based on judgment from management. These judgments are normally based on knowledge and experience about past events to make assumptions about future events. The accounting estimates that are included in the financial statements are listed here. They include property tax receivable and the related deferred inflows, your allowance on your doubtful receivables, useful life, and valuation of capital assets, the valuation of certain donated capital assets, including the streets, fair value of financial instruments, the assumption used to calculate the net pension liability, and the valuation of certain investments for the pension plan. We have reviewed these methodologies and have determined that they are reasonable. The financial statements included in Note 1 are the significant accounting policies for the city. Based on our audit procedures, we believe that these accounting policies are appropriate and comprehensive under U.S. generally accepted accounting principles. We did have some audit adjustments. During our audit, management informed us that there was some errors in the water and sewing billing rates used effective January 1st, 2017, and they provided us an adjustment to correct these rates. That adjustment was for $152,000, and accrual was recorded for the amounts that are due back to the customers. We also had some reclassifications. These are for presentation purposes in the financial statements. And we had one past adjustment for $775,000 related to the net pension liability. The draft of the actuary report, the net pension liability was $775,000 less than the final report that we received. We have determined that this amount is not material to the financial statements. We haven't had any discussion with management regarding alternate accounting treatments. We're not aware of any management consultations with other independent accountants. While this is okay to do, we just ask that we be involved in the conversation so that all relevant facts and circumstances are considered. Any issues discussed prior to our retention of independent auditors were not a condition of our retention. We did not have any disagreements with management. We had no difficulties in performing our audit, and we did not detect any fraud or illegal acts during our audit procedures. We are not aware of any other documents that will contain our audited financial statements. Just want to make you aware of that. There's other information that is included in the CAFR. We have read the other information in the CAFR and inquired as to the methods of measurement and presentation, and we have noted no material inconsistencies or material misstatements. Our areas of audit emphasis are listed here. These are determined based on the risks that we do during our planning procedures, and are the areas that we focus on during the audit. As I mentioned, we also did procedures under the uniform guidance. We audited the city's compliance with the major federal program, which was the Federal Transit Cluster this year, and had no material exceptions. And we have an unmodified opinion on our compliance under the uniform guidance. On the bottom of page 8 is some recent accounting pronouncements that continue on 9 and 10. The most relevant one, which will be effective for fiscal 2018, is GASB number 75, Accounting and Financial Reporting for Post-Employment Benefits Other Than Pensions. That's going to be our OPEB plan. There will be a liability recorded on the financial statements for those next year, and some additional disclosures included, and Dan will discuss the effect of that when he goes over the financial statements. We have other written material communications in Appendix A. This is the management representation letter, which we will present to management. They will sign and return to us. Certain representations are in here that they answered all of our questions, provided us with all the support that we have requested, and they make certain representations regarding the completeness and accuracy of the financial statements. Does anyone have any questions regarding any of these communications?
Okay, well, we'll move on to the second tab, which is the comprehensive annual financial report for the city. Obviously, in the interest of time, we're not going to go through this in a high level of detail, but we will hit some of the major points as well as the items that have really changed from the prior year for your information. On pages 1 and 2, I want to point out the independent auditor's report. Again, as Jennifer mentioned, it is an unmodified opinion, which states that your financial statements are fairly presented in all material respects in accordance with U.S. generally accepted accounting principles. The auditor's report also points out that management is responsible for the financials and then tells what sections of the report that we give an opinion on and those that we don't. Basically, we are giving an opinion on your basic financial statements and notes. We do not provide an opinion on the management's discussion section or statistical information. The basic financial statements are start on pages 12 and 13 with the government-wide statement of net position. And this statement is presented on the full accrual basis and has all of the city's assets and liabilities, including the long-term items like capital assets and debt. A few items to point out. You'll notice, first of all, that there are comparative totals this year. So we have the 2017 information, and then based on a recommendation from Christine, the finance department, Mike in particular, put the 2016 information in the financials this year for comparison. Another thing to point out is in the total column, about halfway down page 12, total assets, the total combined assets of the governmental activities and business type activities now exceed $1 billion, $1,026,000,000. So I believe that that's the first time that has been reported for the city. Of course, the majority of that is within capital assets, about $844 million. On page 13, total liabilities at the end of 2017 were $258 million. The majority of that relates to long-term debt, $212 million, and then your net pension liability of $24.6 million. And we'll talk about net pension liability when we get to the notes. So the city's net position, $766.7 million at the end of 2017. That's an increase of approximately $25 million from the prior year. And the detail of that change, $25 million, is on page 14 with the government-wide statement of activities. The change is the third line from the bottom. You'll see in the total column, 24,886 is the total change, consisting of $13.7 million in governmental activities and then $11.1 million in water and sewer or your business type activities. The city's total general revenues remain strong, $89.9 million. As you know, property tax increased this year about $4.3 million. And the total property taxes were just over $18 million. Sales taxes continue to remain strong, up about 4.5%. State shared taxes actually decreased by about $1.9 million, and that has to do with the Hall income tax in 17 versus 16. 1.9.
We You anticipate that going down about 1.9 each year for the next 4 years?
Hall income tax is very volatile, depending on the market, and so, yes, eventually it's going to be phased out.
Yeah, we know eventually it's gonna be zero.
Eventually it'll be zero, yes.
That's for certain.
Yeah.
Eventually, that 1.9 is gonna run out.
Did we had a reduction? That would be, because sometimes it's confusing, but we've had a reduction in Hall's income tax in 2016 or 2015, whenever because you were saying a 1.9 reduction.
From 16 to 17.
And that's,
Yeah, 16
and
to
that's,
17.
and that's almost all related to the Hall's income tax?
Most of it.
Yes.
Most of it?
On page 15 is the governmental funds balance sheet. And this statement focuses on the city's current resources. So your long-term items like capital assets and debt are excluded from this statement. In the left-hand column, the general fund at the bottom reported fund balances of $43.3 million. And that was up about $4 million from last year. In 2016, the total fund balance was $39.2. The second column, multipurpose capital project fund, is reporting this year a positive fund balance. You'll remember the last two years it had a
Yeah,
negative
that's
fund
right.
balance due to advancing certain capital projects. And so with the issuance of debt in 2017, that fund now reports positive fund balance. So the total governmental funds for 2017 fund balance is almost $94 million. That's up about $36 million from the prior year. Again, $26 million of that related to the debt issuance. The other part was through operations. On page 27 is the conclusion of the budget to actual statement for the general fund. And again, focusing on the third line from the bottom, the net change in the general fund was a positive $4,033,000 compared with the budget of zero. Really, the budgeted expenses were $4.8 million, or actual expenses were $4.8 million less than budgeted.
Right, that was the big difference.
Any questions before I point out just a few things in the notes? All right, if you'll go to page 46, wanted to point out, and we've already discussed this in the meeting, but the pension plan information this year points out the fact that the city's pension plan is now closed and that new employees after January 1st, 17 will go to the TCRS plan. And that's described on page 47 in that second paragraph. And then some additional information about the TCRS plan is included on pages 51 and 52. And next year, when you see these, there will be probably 3 or 4 more pages of notes relating to that TCRS plan. So next year, when you look at this, you'll have a full set of notes on the closed city plan and a full set of notes on the TCRS plan.
And that's very well funded too,
Yes.
absolutely.
On page 52, note G, other post-employment benefits. Jennifer noted one significant upcoming accounting pronouncement. And we've talked about this for several years, but the GASB has changed the way that the city will account for OPEB, or other post-employment benefits, starting in fiscal 18. So currently, if you look at the bottom of page 52, the city's net OPEB obligation or liability that's recorded is $92,400 at the end of fiscal 17. When the new statement is applied and the new accounting is applied next year, the city will be looking at more like a $5 million liability. And so what the difference in the accounting is basically, up to this point, GASB said if the city is funding the plan in accordance with what the actuary has determined, then you don't really record a liability. You record a small liability if you're short a little bit. The new accounting is saying, no, you record your entire liability, no matter how much you've put toward it or not. And so the total liability there at the top of page 53, that second chart, is that 4.9 million. And again, this.
So what do you do with that as far as the budget is concerned, Eric?
Well, that's one of the things we'll discuss with you further, and I think we touched on it last committee meeting, was how we want to classify our existing reserves as they relate to this obligation. We can specifically earmark some of them, or we can just acknowledge that we are carrying reserves
Within our general fund.
overall in our general fund that could be applied to this obligation if it was needed. So that's going to be a policy choice we come to you on, is how much you want to specifically designate, or just recognize that we're going to carry that in our overall or our general fund reserves.
Because it's considered designated, or is it?
It's available for that use,
Available
for that
for-
need. That's the way I
Okay,
would say.
just
it. I don't
available.
know. I'm not the accountant, so
Okay.
that may not be the right way, but philosophically, that's what we'll want to walk through with you, is how much you want to specifically designate for this and this only, or how much you want to say of our overall reserves, we're recognizing we need to have a certain portion that will help us with this if we need to draw upon it.
Yeah, I see what you mean, because on some of the reserve, we've designated
Yes.
some parts of that, haven't we?
Yeah, and so
what you're thinking
that
about.
discussion will apply here. We can make arguments on both sides of that, and so that'll be something I think Mike touched on it last meeting, and something we'll want to bring to you, I think, in the not too distant future.
Yes,
Is there?
I think we've known that in 2018 that this accounting change was coming, but certainly it's not a requirement that we fund differently than we currently fund the program, but we do want to come to you to talk a little bit more about the designation of assets, because there is a philosophical discussion to be had on whether you do want to do anything that would put certain assets in a type of designation in which they cannot be used for anything
Right.
else should the need arise. And that,
Similar to your pension.
correct.
Mm-hmm.
Because, of course, investment, those assets that are designated for the pension are locked forever, for the pension, and so that's the kind of conversation that we want to have with you.
So again, maybe it's the first time person, couple
Mhm.
of questions. So right now, these funds are in the general fund, which are generally invested fairly conservatively for kind of this longer term healthcare retirement benefit. And are we talking maybe we carve some of that out and invest those funds similar to pension liabilities to get?
That can be an option, but that's something that we do want to discuss with you at a different time, because certainly pensions are a long-term obligation,
Right.
and they're there to protect our employees for the rest of their lifetime.
Mm-hmm.
And retiree health care benefits are a different nature of benefits.
Mm-hmm.
Those are benefits that do expire at a certain point, and they're not lifetime benefits. Here at the city of Franklin, there's some entities that do have lifetime
It
benefits.
really covers you between retirement and
Oh,
Medicare
65.
eligibility.
55 to 65 or something.
Yeah,
Okay.
yeah.
Okay.
So it does it does have a
That OP
sunset on it with our
So-
folks, but it does continue to roll too,
So whether the board would want to consider separating assets that really have a different type of duration compared to pension is a conversation that these accounting standards are kind of pushing us to have.
So that's a preview of a coming
Yeah,
discussion,
another
policy
conversation.
discussion.
So are
for
we
you
ready to
and the
get
board.
back to the?
Yeah.
On page 64, two other notes to point out. about a third of the way down the page, tax abatements. This is a new footnote this year, was required by GASB Statement Number 77 to describe amounts of tax revenues that are given up under abatement programs. And then finally, subsequent events, Note P describes, of course, again, the change to TCRS in that first paragraph. The second paragraph describes the approval of the $700,000 excess property tax collections that were sent back to IDB. And then, of course, the $100 million state revolving loan fund approval in September of 2017 is described at the bottom of the page. The remainder of the report has some combining schedules, some supplementary schedules, and of course the statistical information. The last thing I'll point out formally in the CAFR is on page 122 at the very end. And this page is a summary of our auditor's results. And so it goes through the financial statements, the federal awards, and says what type of opinion we've issued, which is, of course, again, is unmodified. And then the fact that we have not identified any material weaknesses in controls or reported any significant deficiencies. And this is really the form that goes to the federal and state government to summarize your audit. And they look at it, of course, in consideration of grant funding. Any other questions?
There'll be some things I'll be happy to look at, but since I hadn't.
Very.
No findings.
Well, I
is
mean,
a
I looked
very-
and our debt now is 150 million compared to 130 million last year. Isn't that right? So, but anyway. Okay.
We must use the federal
I was
government.
gonna say.
We are balancing our budget and paying our bills, and we have a higher bond rating than the federal
There,
government.
exactly.
Just saying.
And it's not a deficit.
Yeah,
either,
that's right.
is it?
That's right.
That's right. Well, any other,
Yes.
this has been very
This is good.
good presentation to us. And thank you to all the people that worked to get all this together. I really appreciate it.
Ladies and gentlemen in the audience.
That's right, as well
Good job.
as
Thank you.
our auditors. Are there some other?
Any other comments?
I don't.
Very well, very good.
Thank you very much.
All right, should we go to the conference center?
Yeah.
Yep, we're
Okay.
ready.
And behind, I guess, the third tab,
Yeah.
in this one we'll go a little faster, but
Yeah.
again, the reports on the results of the audit. On page 2, we've completed the audit, issued or drafted an unmodified opinion on the conference center's financial statements. We confirm our independence. On page 3, again, we have planned and performed that audit to obtain reasonable assurance, not absolute assurance. And of course, we plan and test our audit to, again, to obtain reasonable assurance, but look at internal controls to plan the audit, not to give an opinion on those controls. Management's judgments are listed there at the bottom of page 3. The most significant one that we point out every year is, of course, the allocation of those joint expenses between the conference center and the hotel. 2 audit adjustments on page 4. 1, to record the amounts that were due to the county and the city at year end, $59,000, and then an annual entry to record depreciation expense, $459,000. Really no changes in the significant accounting policies. Those remained appropriate. On page 5, no disagreements with management, no significant difficulties in performing the audit, no material fraudulent or illegal activities that were disclosed to us by management or the owners. And then the audit areas of emphasis are listed there on page 6. And we've included the management representation letter starting on page 7. So again, you can see the types of information that we're asking for during the audit. And then the conference center financial statements are under the last tab. The statements of net position start on page 12. And again, looking at the middle of the page to total assets, relatively consistent, a slight decrease of 136,000 from 11.5 million to 11.4 million at the end of 2017. Majority of that decrease is within restricted cash. That very first line item decreased from 278,000 to 120,000. That's the account that's being used for the renovations and any capital additions at the conference center. So as they wrapped up the renovation project, utilized those funds this year again for capital additions. Total liabilities were consistent, 270,000 approximately in each year. And total net position, 11.1 million the end of 17 versus 11.25 at the end of 16, a decrease of 127,000. And that decrease is described on the next page, which is the statement of revenue, expenses, and changes in that net position. Banquet and catering revenue was down slightly, 74,000. There was about 944 events this year versus 975 last year, so a slight decrease. Also, there was one event, which I believe is the largest event during the year, that was canceled. And so only half of that revenue was recognized as the deposit, and that half is down in other income under non-operating revenue and expense. So that's why that increased from 18,000 to 174. Out of that 174, about 143 is that canceled event. Total operating expenses were 6.9 million, up about 4.5%. The majority of that is due to labor costs. Labor increased about 136,000. Net distributions to local governments, 185,000. So the city and county each received 92,000 based on the operations this year. Two footnotes I always like to point out on pages 19 and 20. On page 19 at the bottom, contractual commitments. The conference center does have 3 contractual commitments with the hotel operator and owner. Franchise agreement, operating agreement, and catering agreement. And there were no significant changes, really no changes to those agreements in 2017, other than they increased by the Consumer Price Index. And then note E, related party transactions, describes those allocations of the joint costs of the hotel and the conference center to the conference center. And those are listed at the bottom of page 20 in the 3 paragraphs. Again, food and beverage costs, general administrative, and advertising costs. Any questions?
If I may add, we do have Michael Sanders and Randy Hanson, who represent Marriott, and as the administrator, they operate the conference center, who are with us this afternoon as well. And they worked with Crossland on this year's audit.
Nina's here.
And we also have Nina Graham from Williamson County, representing our partner on the conference center.
Yes. Okay.
I just know that Dan would be
Yes.
The Margaret question.
Thank you. Yes, Alderman Martin always asks, generally, how are we doing? Right? And the answer is, you're doing well, again this year. As we pointed out, no material weaknesses in controls identified. Your general revenues remain strong, both property taxes and sales taxes. The bond rating that you spoke about earlier, and so you're doing well.
Any other comments here? Again, thank you very much.
Thank you.
Appreciate your work. Okay, so let's see.
May we request recommendations to the full board on
Okay.
these two items?
Okay,
So moved.
that would be
Second.
for the,
Acknowledge.
the audit and for the financial report for the conference center, okay?
So moved.
Any other comments? All in favor, say aye.
All right.
Oh, no? Good, we'll move that then, thank you. Okay, so,
All right, thank you.
Thank you all.
now number 10, the discussion of the status of the capital projects fund. And you know, I really appreciate this because whenever I finally saw it after all this time.
And I think Michael's going to take us through this, but, and Dan in his audit report pointed out how this is
It was on there,
in the
yes.
black now for the
Yes,
first time in a few years, and
Yeah.
that's a good thing, but there's more to it.
That's
And
right.
we
It
wanna
also
walk you
means
through
though that
in
we
great
borrowed a lot
detail,
of money.
and what the function of this fund is, and how we plan to move forward and look at, some elements of how projects have been assigned there and how we plan to manage the fund going forward. So Michael will take you through that. Done a good job of laying this out, but it's got some
Yeah.
complexity to it.
It
So,
does, it does.
we'll take you through this. If we need to come back to this at our next meeting, we can always do that too. There's a lot to think about, but we've got, I think, a solid approach to go forward and how we work with the status of this fund and the needs of this fund going forward. So I'll let Michael. Christine, anything else you want to add, or I'll let Michael take it away?
Take it away.
Good afternoon again. So on page 15 of your audit report, you just saw that the balance of the multipurpose capital projects fund was around $15-ish million at the
15.5.
end of fiscal year 2017. That's the good news. This presentation will begin to work you through what are the components of that $15 million so you can better understand what we are trying to keep track of, and what is giving that positive balance, again, what the capital projects fund is used for, and what remaining deficits are still in the fund that you need to be aware of and that we need to be aware of to propose how we're going to close them.
And this is different in the sense that we really don't have we have a plan for it, but I'm saying it really doesn't come in part of the regular budget.
That's
in
correct.
a
Yeah, it's a
way.
unique fund.
It is, yes, okay.
It's
so-
a multi-year fund that
Indeed.
acknowledges that capital projects do not stop on June 30th and restart on
That's right.
July 1st.
Yes,
So
yes.
the nature of it is a multi-year fund compared to the annual operating budget that you appropriate and those,
Every year.
whatever's remaining lapses at June 30.
So this report is the second of two we've given you. We were here a year ago to try to dive in and say what made up at that point in time the deficit in the fund. And at that point, we had identified between 15 and 20 individual projects that had individual components that were left to finish accounting for or pay off, or they were still ongoing. That list has dwindled significantly, as you'll see in the ensuing minutes. We're going to try to answer three questions today for you. Number one, what is the historical performance of the fund? This fund was invented in fiscal year 2005, so we now have 12 years worth of financial data, or 13, excuse me. What is the current balance of the fund? Both funds, and there's now two funds within this fund. And then, again, what is the plan to alleviate any deficit in the future? There are a series of exhibits provided on each of the following pages, so let's go to page 2. Page 2 is the prettiest because it has the color and the bars.
Well, the red doesn't look quite as good.
It's very Christmassy. yes.
But it's always very Christmassy. Just something we do try to strive for. Remember, tree lighting tomorrow.
That's right. Very good. Good cross promotion.
Thank you. And it ends in a positive. So as Christine was saying, this fund is different than all others for one very basic reason. It's not budgeted. It's a pass-through account, which means we account for all of our capital projects related to the general fund. Water and sewer capital are separate. They're in the enterprise fund. But all other capital projects flow through this fund. So the roads we're building, i.e. Hillsborough Road Phase 2, we're going to account for here, and we're going to put money in from various revenue sources, and we're going to pay it out. Hillsborough Road Phase 2 doesn't get done within a neat July 1 through June 30th period, so that's why we have a fund like this to be able to account for ongoing capital projects. The second major difference is because it's unbudgeted, it can run a deficit if it needs to. And you see the financial performance of the fund since its inception. About half the years it has run a deficit, and about half the years it hasn't. This year it's not running a deficit in lion's share, which is a phrase I use in this report, and I don't know why I went there, but I like lions. Because of the issuance of $23.12 million of GEO debt and the proceeds thereof. So if you turn to page 3, the first exhibit is the balance of the fund on June 30th, or the end of the fiscal year. And as I just said, page 15 of your audit shows that that balance of the multipurpose capital project fund is $15.5 million. We started with a deficit of roughly 7.9 at the end of the previous fiscal year. We added 37.9, almost $38 million worth of revenues. From that, we spent $14.6 million, and the balance is $15.5. The exhibit on your right side of page 3 shows the breakout between two funds. Now, up until this past fiscal year, in fact, budget amendment number 5 of the last year, we had one fund. The nomenclature in the accounting world for the City of Franklin is Fund 310, Capital Projects Fund. We decided, though, as per recommendation of staff, and you agreed to create a separate fund, which is Fund 311, to account for the proceeds and the expenditures of the 2017 general obligation bond. The reason we did this was simple. We think it will be easier to understand. We can allocate all of the proceeds from that one issuance. We can spend it down in one place, and when that those proceeds are spent, that fund will no longer be used. That separates out the current activity related to that bond separate from any ongoing or prior activity which is in Fund 310. Now, for the purpose of your audited financial statements, this is all the Capital Projects Fund, so it all rolls up into one. You see this as well within Water and Sewer. There's multiple sub-funds in Water and Sewer, but again, they all roll up and are accounted for in one. Everybody good so far? Okay. So the good news is we're in a positive fund balance overall. The bad news is there was a deficit still within Fund 310 of about $2.3 million at the end of June 30th. That balance has actually grown.
That's right. That's the other thing.
So turn to page 4. In order to understand the deficit that needs to be closed, you need to understand where we are as of 2 weeks ago, which is when we produced this and tried to reconcile as much as possible. And unbelievable thanks is due to Glenda Driver, who is still here?
Yes, she is.
Glenda's still here. Glenda did a tremendous amount of work to assist Mike and I and Christine in terms of accounting for and validating all of the individual projects and where things get cleared out. So this is a good meeting for affirmations, so I wanted to make sure to give a shout out where appropriate. I'm not going to cover 311 any further simply because we've continued to spend out of that primarily for Hillsborough Road Phase 2, but there's still $15+ million in that fund. Since June 30th, in Fund 310, however, we started with a deficit of $2.3 million. We added $1.9 million in revenues, and we have spent or accounted for $5.8 million in additional expenses. Now, the lion's share of that is ongoing work to develop MacCatcher Northwest. It's being charged against us. It will be reimbursed by the state. So that will go away. However, this is where we are as of this exact moment. Turn to page 5. We start with a balance of negative 6.2 million. And in order to figure out exactly where we are, it's important to segregate out 3 things from that deficit of 6.2. First, take away the balances of all the outstanding projects. We would label these also current projects. So Franklin Road, initial work on Columbia Road, MacCatcher Northwest, Mallory Green developer contribution, et cetera, et cetera. Positive balances are fund balances we have, meaning we've got grant or developer contributions or money that has not been spent yet. Negatives are money which is owed to that project. You take away that accumulated amount, you have a deficit of 3.8 million. The second thing you need to account for are the remaining transfers to come out of the fund. Institutional memory moment number 2. Last year during amendment number 5, we asked you and you approved the transfer of $3.4 million of county facilities tax monies out of the capital projects fund, where via resolution 2010-69, previous boards had put the proceeds, our share of the county facilities tax, into the capital projects fund. Again, for the purposes of transparency
We were using them.
and understanding, we felt it better to keep that revenue now separate. The reason, of course, is, as the chairwoman just said, was because those funds we use for various capital projects related to county facilities. That's been our practice.
Basically
Schools in particular.
Schools in
In
particular.
and around schools.
In and around
Infrastructure,
schools,
right.
yes. Not the schools themselves, but in and around schools.
Yep.
The million,
Crosswalks.
the million,
Hillsborough-
the million you're
Hillsborough
giving to
Road.
Oakview for the middle school.
Right,
Yeah,
for
yeah.
the sewer.
And Hillsborough Road, too, because it's next
Yep.
to the high school, yeah.
This is going to be part of a future budget amendment. You will see this probably in January to transfer the remaining portion of county facilities, which was accumulated in the fund, out. And then finally, there are 2 years' worth of unrestricted property tax revenues, which we also put in this fund. That was the 1.5-cent increase in property tax voted by the board in 2015 and 2016, which has never been allocated, but has stayed in that fund. This raises the total deficit back to an amount of $5.69 million. And after we've accounted for all other projects, and we've cleared the books on very small balances, the amount owed is attributable to one, and that's South Carruthers Extension. Now, why? One word, and that's opportunity.
Well, the other word is that we didn't have enough money coming in road impact fees to pay for it.
And
But
part of the
anyway.
part of the solution follows along that feeling. This was a project which was not originally in the 2014 through 2018 CIP when it was developed. We recommended, the board affirmed, taking advantage of the opportunity of the growth in that area of the community to build that road in a timely fashion. In doing so, it simply got out of sequence with our intent resolutions and our ability to borrow sufficient funds on a timely basis to fund this, which is why a deficit still exists. All of staff and our bond attorneys did tremendous research leading up to the 2017 GO issuance to see every possible bill that could have fit under our intent resolutions to see if we could borrow to reimburse ourselves. And I think roughly 6.4 million of that 23 million was reimbursable expenses.
Around 7 million.
7 million.
Mhm.
This portion, however, was not. There's a particular window, and I don't know if you want to explain more about how that works.
Well, there's so much detail and small nuances related to tax exempt bonds, and one of the nuances of certainly to go back and reimburse ourselves for expenses. We one of the requirements is to adopt an intent resolution, and that was done in this case. However, there's some additional rules that when you actually get ready to issue bonds, one of the rules is that there's a time frame from the completion of a project until bonds are issued. And that was the specific rule that applied to South Carruthers. Actually, from the time a project is completed, even with an intent resolution in place, you've got 18 months to close on bonds. And we worked very closely with Bass, Berry & Sims. We pulled individual invoices, and then we had the conversations of really when is a project complete, in this case a road project, and is it when it's open to traffic, is it when we went through the very specific conversations on this project, as well as several others that were done, in that time frame, and it was determined that there were expenses which were not reimbursable from tax exempt bonds, and certainly our capital program is not a 100% bond funded program. The capital program that we're in right now is about 60% debt funded. So what we did go back and we had talked with this committee before, as Michael was alluding to when we did the budget amendment, was allocating cash in road impact fees specifically, as well as some other cash that's available to help pay toward these expenses, because it's not a 100% debt funded program. However, for some of these large projects, I believe there had been conversation that that it may have been as likely to have put more of the bond issue to projects that had been completed. What we did start working on, and you can tell this change in a little bit of change in direction from Michael's his nice Christmas tree, Christmas chart that's on page 2. I'll point out to you the history of this fund, and certainly with a place that's growing as quickly as Franklin, the capital needs are as great as they are. You can see the deficits, and then the balances that come in once bonds are issued, primarily reimbursement bonds. What we worked on this year with the 2017 bond issue, we do have the reimbursement component, but we also worked very closely with our engineering department. What are the expenses for projects that will be, we actually talked about the next 2 years. Tax law has us spend bond proceeds in 3 years, but let's talk about the next 2 years. What projects with what expenses do we anticipate finishing in 2 years, and going ahead and including those proceeds in the 2017 bond issuance that closed at the end of June. That way, we know that there's a complexity to road projects specifically, but in working together with our engineering director, we can work together on using bond proceeds rather than being back into a reimbursement type situation, and that's something we did a report here at our last meeting on what was left in bond proceeds. So we're going to be managing bond proceeds rather than reimbursing ourselves with bond issues at the end of these large projects. And Eric may have a.
No, I think that covers it pretty well. I think as we look at this, and Michael talked about it, that project in particular fell between capital planning windows. I think we had been hopeful to incorporate it in a bond issue, and if we had it to do over again, we might have timed a bond issue earlier so that those could be assigned. But it's still a project, and as we get to the next piece, you'll see we can assign a portion of general fund dollars that were identified for capital projects, and especially road impact fees, which make a lot of sense to assign to a project like that is providing service to one of our fastest growing areas of the city. So I think it makes a lot of sense in terms of how we're addressing it and putting the fund where we want it over the next 2 to 3 years. And then our go forward is this essentially every other year, a bond sale that aligns with our capital plan. So you look at the odd number of years, you can count on us probably doing some level of bond sale that ties to your 10-year capital plan. That way we kind of keep it in that cycle, helps us make sure we assign it so that we don't get out of step with the reimbursement standards. And so I feel like, and one of the things that Christine, working with Mike and Michael, have engaged the project management side of the house a little more, and seeing how that has to work and projecting out what the projects are going to need in that 2-year window. So I think that will make all this ultimately work. And so, you know, the fund did what it was supposed to do, and we used it the right way. It's just aligning the debt, the strategic use of debt with this project. You know, we are where we are now, and we have, I think, a good strategy
But we've got a
to
good
address it going
strategy
forward.
now.
And
Don't we?
fortunately, we've got road impact fees have materialized to the point that they
That's
help us
right.
with that too. And ideally, I would want to assign road impact fees to that project
Yeah,
because of the
but at
nature
the
of that project.
time,
It
it was
wasn't there at that
iffy,
time.
wasn't it?
Yeah, so in some ways, it's kind of worked out in a good way, because that's the kind of resource you want to assign to a growth-related project like that.
Exactly.
Because a lot of the development in that area has paid road impact fees. And we can point to right outside their door and say, you help pay for that road. And that's a good thing.
That's the way it should be.
Yeah, right, exactly. Philosophically, that's what it's there for. And so, and we have moved to, at least at this point, using that more as a pay-as-you-go resource related to projects than a long-term debt-funded. We still have a significant amount of debt assigned to that fund, but we're not adding debt to it at this point. We're using it more on a project-by-project basis. You see that on this sort of retroactively, but you also see it integrated into some of our thinking about new projects that are coming forward that are particularly impacted by growth, and that we know are paying a decent amount of impact fees in, either through the project funding strategy itself or through offset agreements like you saw on Tuesday night. So maybe we want to step to the move forward or go forward strategy to address the future deficit.
If you turn to the last page, page 6. We recommend a 3-pronged strategy to close out the South Carruthers costs. The first is, we recommend that you apply the property tax revenues which have been sitting in the fund for several years that have gone unallocated. This is the easiest thing because it's already in the fund. It doesn't require a budget amendment. It doesn't require any movement of monies. We just internally effectively apply that 1.2 million to this balance. The second is, as part of the last budget amendment of the year, we transfer $1.5 million out of the road impact fund. And I'm going to say, quite honestly, at least $1.5 million. Also, in your comprehensive annual financial report, you have one page dedicated to the road impact fund. The fund balance at the end of June was 5.8, going on $5.9 million. We feel comfortable that we dedicate $1.3 million of that, regardless necessarily of how the fund performs this year or is trending. That should be enough to sustain fund balance, not get us into some of the troubles we had when development was not proceeding as quickly, but begin then to take about half of this remaining deficit away this year. The third and final strategy would be, as part of next year's year-end close, apply both general fund dollars and road impact funds to the tune of about $1.5 million and $1.5 million. Again, though, let's see where we are at the end of fiscal 18 and where we are at the end of fiscal 19 to see if we can accommodate that. We believe we can. We believe it's responsible for the balances of both funds to meet this aim.
And we want to make sure we're maintaining a fund balance in that road
That's
impact
right.
fee of at least
Just in
a full year
case.
of debt service, at a minimum. And so we think conservatively, we still provide for that. We may be able to put a little more in there sooner, but that way you'll have addressed it with a combination of dedicated general fund capital funding dollars and road impact fees. And I think that makes a lot of sense in terms of where we wanted to allocate those kind of funds anyway, and gets us to a point where this won't continue in beyond the next fiscal year to be part of that fund. And then we'll really just be going
And doing
by
what we-
project cycle.
Exactly.
I mean, it'll be that 2-year cycle.
There will always be fluctuations in this
Sure.
fund. It will either be positive or slightly negative. The goal is that it's not slightly negative. It was made abundantly clear to me in a previous meeting. But that you're going to have a lot, there will constantly be
Sure.
ins and outs because it's designed as a pass-through account. I didn't know if, Christine, you wanted to touch on the moving forward and to, again, summarize what we've done and what we'll do in the future.
I think I'd probably talked a little bit about that a few minutes ago, but certainly by setting up the accounting structure that Michael did a wonderful job explaining with Fund 311, that is just getting us moving forward with having bond proceeds that we issue and we spend on projects that we anticipate spending funds on the next between 2 to 3 years. That's something that we want to be able to, and working together, you'll see that we, hopefully when we get back here together for the next bond issue in 2019, we'll be proposing projects that the city engineer, since 75% of our capital plan is roads, that the city engineer recommends that he believes will be accomplished in that 2 to 3 year time frame that the IRS says that we have to spend bond proceeds, and we'll work together, as departments to spend those in accordance with that time frame. So we do have the mechanisms in place to be able to do that, and we appreciate that this has been a very detailed effort, and going through the audit process and then the reconciliation here to get to this point. We propose a plan. We have put a great deal of deliberation into it in the last couple of months, but certainly we do believe that going forward that we believe that we do not intend to have a deficit in the capital project fund. So we have very good collaboration with our engineering department, and we have a lot of support from them to move forward as well.
And this needed a good look, but
Yeah.
you've taken really good care of it.
There's
I
a lot of
think.
detail involved, and
Yes,
appreciate the
yeah.
work of everybody.
Yes.
Glenda especially, and everybody and working on that. So from the committee and the board standpoint, there'll be a budget amendment as part of the closeout of fiscal year 18. And then we'll integrate kind of item number 3 on the list into the fiscal year 19 budget when you see that. That'll
Right.
just be, so that'll really be the extent of what you need to do to help us implement this strategy if you're comfortable with this approach. We think this addresses it in a pretty timely manner, uses the right resources to get us where we need to be,
Exactly.
and then we're on to really a prospective 2-year cycle on managing capital projects. So that's really what you need at this point, and we're glad to answer any other questions you have.
Very good, very good. Now, but do we need to, this is just
I don't
kind
think
of
you
a
need to act
discussion.
on it.
Yeah, that's
You'll
right,
see it
okay.
in an
Okay.
amendment form.
Whenever
for
it comes
Item
up.
number 2 on the strategy.
Yeah.
And then item 3
Yeah.
will just be part of our planning for the fiscal year 19 budget.
Okay, so then are we ready to look at item 11, the monthly reports?
Now that you've heard the results of the audit, we as staff, we would also like to thank this committee, the full board, Eric and Christine, for your support and guidance, because we know you help us to make it happen. For the monthly reports, you heard from Dan and Jennifer where we were at June 30th. Well, we know accounting information continues.
That's right,
So what you have in
exactly.
the package is you actually have the first quarter report. And what we'd like to do is just point out, just very briefly, and I actually want to point out some positive things that have impacted the financials from board actions. Like most first quarters before the property tax, we're in a deficit position. That seems to only be for the first quarter. Once we have property tax, that typically will go into a surplus position. In July, the increases of pay went in, the 2.5 across the board and the 2.5 for performance. You notice sales tax, though, was only a 4% increase. We would always hope it would have been higher, but we always know that a lot of it is going to be dependent on what we see for the Christmas sales. So it's kind of one of those, it's kind of a look and wait and see. So we're kind of hoping once those numbers come in, we're maybe hoping it'll be where we kind of expected that increase to be for the fiscal year.
Yeah, I was thinking, though, in fact, I had written down, it looks like very often our biggest projection is going to be on sales tax, and, you know, it's the one that's falls behind. I mean, you know, you're really working on 3-month-old numbers whenever we're trying to put the budget together and everything. But I think we maybe have projected a little bit higher estimate in the last, maybe this may be the 3rd year in a row, that it really turned out not to be as much by the end of the year. And then we had already projected on what we thought it was going to be at the end of the year, and we also probably projected just a little bit higher. It's just something to think about, I think. It's not a lot, and but since that's such a huge part of our
It's
general
largest
fund,
general fund revenue source.
absolutely by far. But I just wanted to say, it's again, you know, it's kind of just, it didn't turn out, didn't they say it was 4.6% based on the audit? And I think we had projected more than that for that year too.
In the fiscal 17 ended up being a projection closer to 5.
Yes, the projection, yeah, that's right. Good point.
In January, your next meeting, you will receive our best revenue estimates
Sure,
and the revenue
sure.
model for fiscal 19.
Yeah.
We scour the ends of the Tennessee economic cycle in order to do that. And one of the principal documents we look at is the composite revenue forecast out of testimony on Capitol Hill that was given in the last couple of weeks. You will likely see sales tax projections, which are going to be less aggressive in their factor of growth
that
in
would be
fiscal 19 than you've seen before.
Good.
It will still grow. And,
Absolutely.
And we generally, you can go onto the open performance site and see, there's a good graph that shows we've generally beaten state sales tax performance, and we believe a good rule of thumb is that our forecast will be about 0.5% higher than what the
Okay.
overall state is looking at. That's generally how we've performed since the end of the recession. They're looking, the most conservative economist at the state level is saying 2.5 to 2.75 growth. The majority of them were saying 3 to 3.5. So again, you will see a ratcheting down gradually of this.
Well,
Yeah.
that's just what I was wondering, because you know, it's the hardest one
Yeah.
to try to figure out,
Right.
because it's always 3 months behind.
Right.
I can understand that.
And
but
we
I-
did bump it down in FY 18, the current year
0.5%.
budget.
Right.
About a
right.
0.5% from where we were in
Yeah.
the FY 17 budget, so this just continues
Yeah,
that
but
same
it turned out
approach.
that the FY 17 was really lower
Yeah.
than we thought it was.
Right.
So that, but again, I appreciate that, because that was kind of my comment.
Comment that I'm glad we're looking at it like that, being conservative, because just looking at post-Thanksgiving, you know, Cool Springs, you know, when you have our big box stores with 1 or 2 clerks, you know, checkout places, we're gonna push people to online purchasing, and that is a lower percentage. Or is there any tax coming
We
from
don't,
online
we don't get that,
sales?
basically.
It depends.
It just depends.
That's the very
Well,
detailed
well said.
answer we can give you, it
Yeah.
depends.
Well, we gotta keep our malls and things going and active, because right now, if we don't have the workforce there to service the customers to come there and spend their dollars, they will go elsewhere, and I think we're beginning to see a little bit of that. No alarm is here, but I think we need to be very conscious that when you go to places that you don't have, as many people checking you out to take your money, and we all can testify to that. Just a comment.
Sales tax on food.
Yeah.
Oh, I think that's right. And then please-
Part of the
And that affects the
right.
state shared revenue category.
Thank you for saying that.
I would think, just sitting here, that, and there's no way to project it, but I would think that our position, depending on sales tax, because I see it going on, I see it going online. I see people ordering, Amazon, whatever they're ordering from. And I don't know I don't know whether we've collected the sales tax on that or not. I don't know how that works necessarily. But that, I mean, I don't want to use my house as an example, but I will. But I mean, there's something at the front door every day where someone has ordered something from somewhere. And, you know, with us sitting in the position we're in, it just doesn't appear I think, and this is not tomorrow's problem.
Yeah.
But at some point in time, we'll have to go back, somebody's gonna have to go back and take a look at how we fund the city's operations. Because I don't think you're gonna be able to depend on sales tax.
All right, well, let me tell you,
Not to
there
the
is,
degree that we are today.
that's right, not-
Mhm.
but there is one thing that we do have to look forward to, and that's when we pay off that TIF.
Well, that's true.
And that's not going to be as long as, you know, it was projected to be. Then we're, all of a sudden, we're gonna have a we're gonna have a very large increase in the general property tax. I mean, and that's not gonna be that long way. But anyway, gosh, we would have to watch it because the other people are
Yeah.
coming in here, sorry, sorry.
The last two items I would like to highlight go back to board actions. If you look at state share taxes, it's up 16%. And if you think about what we saw in the news about sales tax would probably go down, what happened was Franklin did its special census. So in essence,
point.
even though
Good
the amount
point.
could have gone down, by taking the action of the special census, we actually are seeing an increase, at least in the first quarter. And the second item we'd like to highlight is in the sanitation fund. Because of the $1 increase, you look at the expenses in the fund, and
That's interesting.
because of what's being collected, it is now covering the operating expenses and the tipping fee expenses. So whereas in prior years, we've had a contribution go to it from the general fund, at least as of the first quarter, that new rate is now seeming to cover the amount of the expenses so far in that first quarter.
So far, yeah.
So far. And that's the thing about probably when you look at a quarterly report, because you'll notice also it said something about road impact fees were triple of last year. The reason we do a monthly report is we want to keep you apprised of any changes.
That's
So
right.
that's why when you looked at the next month,
Yeah,
you'll
if you
notice
look
it
on the
went
monthly
lower,
reports,
because
yes.
what happened was in
Yes,
the month of
exactly.
September, you had $2 million.
Yeah,
So
yeah.
in essence, it's all based on the timing of development.
Yeah.
But in essence, that's how the monthly reports coordinate with
Yeah.
the quarterly reports.
Yeah, and so really looking at both of those together.
Can I make one comment?
Sure, please.
You mentioned internet sales, tax on internet sales, and I think we collect from Amazon, but there are many other magazine people that or sales catalog people we don't collect any sales tax from, and that has been something that we've written frequently about to our
True.
congressional delegation. And I think that as we consider newly elected people to go to Washington, that may need to be a question we ask them is, how do you feel on this issue? Because we're going to continue to see internet sales continue to rise, and malls are going to continue to come under increased stress as they have to try to reinvent themselves. So.
And we have been fortunate that our mall has
Been
reinvented
reinventing
itself.
itself.
It's one of the ones that's been noted nationally.
So if I go to Macy's and I can't get checked out, and I go home and I go online and order from Macy's,
You're going to pay tax.
will I?
You won't.
Yeah, but if you order from LL Bean,
Okay.
Oh, okay.
you're not
So,
going to pay
okay.
tax.
I was just wondering.
There's a whole list of them. Look at some
Look
of
at the
your
list. Yeah,
catalogs.
yeah,
that you
okay.
get.
You have a comment, because we're trying to finish up.
Make it quick, because I know you're in a hurry. 'cause
Yeah.
We've got our meeting.
That's right.
I'm sorry I just got here a little while ago, but it's good to hear you talking about this. I'd love to know about what you think, how fast, or what's the date we think we'll pay that TIF off? Because I'm very interested in that. Ann brought up a really good
Yeah,
point.
they haven't been, that's not what they were working on. I've
But
got something about it.
If you've got a presence, like the mayor was saying, if you have a presence here in Tennessee,
Physical,
then you're paying state tax, you're paying sales tax on that, on the internet. If LL Bean doesn't have a store here, you're not paying that. When Amazon brought their distribution center here, then you're paying on that. That's how those things work. But, you know, I was just telling the mayor the other day, I went to the National League of Cities national meeting, and there's some things that they were talking about, and we know the malls are going to go away. We'll know that big mall we have over there will be all taken down one day and redeveloped.
Well, let me
Because
tell you, though, I want to say the Wall Street Journal had an article about
I read that.
malls in the last
Yep.
3 or 4 months, or maybe 6 months, and they named Cool Springs as one of the ones that was doing an excellent job.
Right.
It doesn't mean it's gonna last forever.
No, but I read that
still-
article too.
But still.
And it was interesting, but they said within 10 years to 15 years, we're gonna, it's just like the autonomous cars, et cetera. But I was telling the mayor, the truth about your future, the money guide you need now, later, and much later, by Rick Elderman. He's an economist, a very well-respected economist. And
Pass
that
it on to us.
talks about our education system, our jobs, our malls, our retail. And one of the sessions I did go to up there was about retail, what we're doing with retail in the future for our cities, especially cities that rely on heavy sales tax. So it was interesting, sometime we'll talk about it.
Do you have anything else we need to say? Okay, so, are we, is there a motion to adjourn?
So moved.
Favor say aye.
Tell you what.
Aye. Let's get out of here.